If you observe carefully the history of the last 500 years, you'll see a pattern that repeats with almost mathematical precision. This isn't an apocalyptic prediction. It's a logical consequence of forces already in motion. When an empire faces unsustainable debts, when productivity can no longer keep pace with spending, when confidence in the currency begins to waver, something inevitable happens. History is an excellent teacher, and it teaches us that we're living through a moment of transition that occurs on average every 75 years. The last great cycle ended in 1945. Do the math. What we're seeing today, persistent inflation, geopolitical instability, changes in the global monetary system, these aren't isolated events. They're symptoms of a larger pattern that few can see. But if you understand how these systems work, if you comprehend the incentives behind the decisions that shape our economy, you can not only protect yourself, but prosper during this transition. Because in the end, wealth doesn't disappear, it changes hands. To understand what's happening now, we need to look back. In 1944, the world gathered at Bretton Woods to create a new monetary system. The US dollar became the global reserve currency, backed by gold. The United States emerged from World War II as the dominant power, with the largest economy, the best military, and the most trusted currency in the world. This was the beginning of what we call the American order. But history shows us that no order lasts forever. Look at the Roman Empire. For centuries, its denarius was the most stable and accepted currency in the known world. But when Rome began facing costly wars, when its expenses exceeded its ability to generate wealth, when productivity stagnated, they did what all empires do. They began to print more money. In Rome's case, this meant mixing silver with cheaper metals. In the case of 17th century Holland, it meant creating more debt securities. In the case of Victorian England, it meant expanding credit beyond the capacity to pay. And in the case of today's United States, well, you can see the numbers yourself. America's national debt rose from $1 trillion in 1980 to more than $33 trillion today. Federal government spending has grown exponentially. The ability to pay through real productivity hasn't kept pace with this growth. If you understand incentives, you understand behavior. When a country can no longer pay its debts with real productivity, only one option remains: create more money. And that's exactly what we're seeing. Since 2008, and especially since 2020, the quantity of dollars in circulation has increased dramatically. The Federal Reserve created trillions in new currency. Other central banks around the world did the same. This isn't a conspiracy. It's an inevitable mathematical consequence. But here's the crucial point that most people don't understand. When this happens, when confidence in the dominant currency begins to waver, global economic power redistributes. We're living through this moment of redistribution now. To understand what comes next, you need to understand how what I call the economic machine works. Imagine the global economy as a circulatory system. Money is the blood. Central banks are the heart. And confidence is what keeps everything functioning. For decades, the US dollar was the blood that fed this system. Countries around the world held dollars as reserves. They bought and sold oil in dollars. They conducted international trade in dollars. This gave the United States an extraordinary privilege. They could print the currency the world wanted and use that currency to buy real goods from other countries. But privileges based on confidence are fragile, and confidence, once lost, is almost impossible to recover. In recent years, we've seen something that hadn't happened for decades. Countries began openly questioning the dollar-based system. China created alternative payment systems. Russia accumulated gold and reduced its dollar reserves. BRICS countries began discussing alternative currencies for bilateral trade. This doesn't happen overnight. It's a gradual process, like melting ice, imperceptible at first, then inevitable. And when confidence in a reserve currency begins to waver, three things happen simultaneously. First, inflation accelerates in the issuing country. because when other countries stop accepting your currency in exchange for real goods, you need to offer more and more monetary units for the same products. Second, real assets become more valuable. Land, commodities, productive companies, precious metals, everything that can't be created from nothing gains relative value. Third, economic power redistributes geographically. New centers of production and trade emerge. New currencies gain importance. We're seeing exactly this happen now. American inflation, which was dead for decades, has returned with force. Commodity prices, from oil to wheat, from copper to gold, have experienced extreme volatility. And countries that previously depended entirely on the American system are creating alternatives. This isn't a prediction, it's a description of what's already happening. To fully understand the moment we're living through, we can't ignore the elephant in the room: China's rise as a global economic power. In 1980, the Chinese economy represented less than 2% of global GDP. Today, it represents more than 17% in purchasing power parity. It's already the world's largest economy. This isn't just an interesting statistic. It's a fundamental shift in the distribution of global economic power. If you observe history carefully, you'll see that changes of this magnitude always result in reconfigurations of the international monetary system. When England surpassed Holland as the dominant power, the pound sterling gradually replaced the Dutch florin as the global reserve currency. When the United States surpassed England, the dollar eventually replaced the pound. Now we're living through a similar transition, but with an additional complexity. This time, the emerging power has a political and economic system fundamentally different from the established power. This creates tensions that go beyond simple economic competition. It creates what experts call the Thucydides trap, the tendency for conflicts to arise when an emerging power challenges an established power. We're not necessarily talking about military war, although that possibility can't be completely ruled out. We're talking about economic, technological, and monetary warfare. And this war has already begun. We see it in trade tariffs, we see it in technological restrictions, we see it in financial sanctions, we see it in the race to develop central bank digital currencies. Each of these moves is a piece in a much larger game, the redefinition of the global economic order. And as always happens during these transitions, the losers are those who can't adapt to the new realities. Now, you might be asking yourself, all this is fascinating from a historical perspective, but how does it affect my retirement, my house, my savings? The answer is dramatically. I'll be direct. If your financial strategy still assumes we'll live indefinitely in the world of low inflation and dollar dominance we've known for the past decades, you're preparing for a reality that probably won't exist. Let me explain through a concrete example. Imagine you're a typical five-year-old American. You've worked your whole life, saved money in savings accounts and CDs, contributed to your 401k, investing mainly in American stocks and treasury bonds. Your plan is to retire at 65 with about $1 million. In a world of low inflation and stable economic growth, this plan made sense. You could withdraw 4% annually, $40,000, and live comfortably. But what if the average inflation of the next 10 years is 6% instead of 2%? What if the dollar significantly loses its international purchasing power? What if treasury bonds, traditionally considered risk-free, actually become one of the riskiest asset classes? Suddenly, that $1 million doesn't buy what you expected. Your $40,000 annually has the purchasing power of maybe $25,000 in today's dollars. Your comfortable retirement becomes a financial struggle. This isn't catastrophism, it's mathematics. When currencies lose purchasing power, and all fiat currencies eventually do, assets denominated in that currency lose real value, even if their nominal values rise. The good news is that if you understand these patterns, you can position yourself to benefit from changes instead of being a victim of them. Throughout my years studying economic cycles and building investment strategies, I've identified some fundamental principles for protecting and growing wealth during periods of monetary transition. The first and most important principle is true diversification. But when I say diversification, I'm not talking about the traditional diversification that financial advisors usually recommend: 60% stocks, 40% bonds, all denominated in US dollars. I'm talking about diversification across asset classes: stocks, bonds, commodities, real estate, precious metals, geographies: United States, Europe, Asia, emerging market currencies: dollar, euro, yen, yuan, Swiss franc, economic sectors: technology, energy, agriculture, mining, and time horizons: short, medium, and long-term investments. The idea is to create a portfolio that can benefit from any likely scenario instead of betting that the world will continue exactly as it is today. The second principle is to understand and accept volatility. During transition periods, markets become more volatile. This isn't a bug, it's a feature. Volatility is the price we pay for the opportunity of greater returns. If you can't sleep well when your investments fluctuate 20% or 30% in a year, you're probably taking too much risk. But if you're so conservative that all your wealth is in safe assets denominated in a currency that may be losing its special status, well, you may be taking the biggest risk of all. The third principle is to maintain strategic liquidity. During transitions, opportunities appear quickly. Solid companies become temporarily undervalued. Real estate is sold at liquidation prices. Productive assets can be acquired for fractions of their intrinsic value, but only if you have capital available to act when these opportunities arise. The fourth principle is to focus on productive assets. In the long run, real wealth comes from the ability to produce goods and services that other people value. Shares of solid companies, well-located real estate, agricultural land, natural resources. These assets continue generating value regardless of what happens with monetary systems. I'll be even more specific about how to apply these principles. For the fixed income portion of your portfolio, consider diversifying beyond traditional U.S. Treasury bonds. Inflation-indexed bonds, bonds from other developed countries, and even some commodities can offer better protection against monetary devaluation. For stocks, don't limit yourself to just the American market. Some of the greatest opportunities of the coming years may be in emerging markets, especially in countries that are net beneficiaries of the geopolitical changes we're seeing. Also, consider allocating a portion of your wealth to real assets. Real estate, especially in strategic locations, historically offers good protection against inflation. Precious metals, although volatile in the short term, have thousands of years of history as a store of value during periods of monetary instability. And don't completely ignore new technologies. Cryptocurrencies may be volatile and speculative, but some of them represent genuine attempts to create alternative monetary systems. A small allocation may make sense as a hedge against instability in the traditional system. But remember, the key isn't to bet everything on a single thesis. It's to build a robust portfolio that can prosper in multiple possible scenarios. Many people recognize that changes are happening, but believe they have time to prepare later. I'll adjust my strategy when things become clearer, they think. This is a common and dangerous reasoning error. Systemic changes don't happen linearly. They follow what mathematicians call a Pareto distribution: long periods of apparent stability followed by rapid and dramatic changes. Think about the collapse of the Soviet Union. For decades, it seemed like a stable and permanent system. Then, in a matter of months, it completely crumbled. Those who waited for clearer signals missed the opportunity to position themselves adequately. The same pattern applies to monetary systems. The transition from the gold standard to Bretton Woods happened during the crisis of the 1,930 seconds and 1,000. The end of Bretton Woods happened quickly in the 1,970 seconds. Now we're seeing the initial signs of another systemic transition: persistent inflation, geopolitical instability, questioning of the established monetary order, development of alternative systems. These aren't independent events. They're symptoms of a system under stress. And when systems under stress finally break, they break quickly. Therefore, if you're going to make adjustments to your financial strategy to adapt to new realities, the time is now. While you still have time to make deliberate and calculated changes instead of panic reactions, but protecting and growing wealth during systemic transitions isn't just about choosing the right investments. Personal skills become more valuable during periods of uncertainty. Skills that allow you to generate value regardless of the specific economic environment are assets that no inflation can erode. Relationships also become more important. During crises, people who have solid networks of personal and professional relationships do better than those who depend only on institutional systems. And knowledge, especially knowledge about how economic systems really work, becomes a significant competitive advantage. If you understand why certain things are happening, you can position yourself to benefit from them instead of just reacting to them. Therefore, I recommend you continue studying. Read economic history. Understand how currencies, central banks, and international trade work. You don't need to become an expert, but you need to understand enough to make informed decisions about your own financial future. Because in the end, no one cares more about your financial security than you do. Throughout this entire process, it's crucial to maintain the right perspective. Systemic changes can seem threatening, especially when you've spent your entire life getting used to a certain set of rules. But change also creates opportunity. The people who benefited most during the transition from the gold standard to Bretton Woods were those who understood the implications of the changes and positioned themselves adequately. Those who benefited most during the end of Bretton Woods were those who anticipated the era of high interest rates and inflation of the 1,980 seconds. And those who will benefit most from the current transition will be those who understand where the world is heading and position themselves adequately. This doesn't mean making risky bets or trying to predict exactly how events will unfold. It means building robust strategies that can prosper in multiple possible scenarios. It means accepting that uncertainty is the only certainty and building your financial life around this reality. It means understanding that although you can't control global economic and geopolitical forces, you can control how you prepare for them. If you observe carefully the last 500 years of economic history, you'll see that systemic changes aren't exceptions, they're the rule. Monetary systems change, dominant powers change, technologies change, generations change. The only constant is change itself. But within this constant change, there are patterns, cycles, principles that remain valid regardless of specific circumstances. The principle of diversification, the principle of focusing on real value instead of nominal value, the principle of maintaining liquidity for opportunities, the principle of understanding how incentives shape behaviors. These principles worked for investors during the Great Depression. They worked during the decades of high inflation in the 1,970 seconds and 1,980 seconds. They worked during the tech crisis of the 2000s and the financial crisis of 2008. And they will work during the changes we're living through now. History is an excellent teacher, but it only teaches those willing to learn. If you understand that we're living through a moment of historical transition, if you accept that the rules that govern the last decades may not govern the next ones, if you're willing to adapt your strategy to new realities, then you won't just survive the changes that are coming. You'll prosper during them. Because in the end, wealth doesn't disappear during systemic transitions. It just changes hands. And with adequate preparation, these could be exactly the right hands. The choice, as always, is yours. But choose wisely, choose with knowledge, and choose while you still have time to make deliberate choices. Because history doesn't wait for anyone. And cycles, once in motion, are unstoppable. The only question is, will you be prepared when they arrive?